Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, April 18th, 2016. I decided to do a video. I haven't done a broad market video in a little while. And as I stated recently, my focus right now isn't so much on the broad markets because there is a lot of sector rotation going on, and the broad markets, for the most fact, have gone virtually nowhere in the last month or so. So there aren't any new developments to really cover. Let's take a look and I'll illustrate that. We've drifted slightly higher, but I'll pull up, flip to a 60-minute chart, hourly chart of the Qs. And if we take a look here, let's just look back about a month. Here's a reaction high on March 16th, and as I said, today is April 18th. So let me capture that high, get the high of that candlestick. We move it over here to where we're trading today. And if you look at the box, go down towards the bottom in green. I have to get the crosshairs back on there. You can see we're up about 2.98%. So 3% gain in the last month. Yes, the trend is slightly upwards, but for the most part, at least in my book, that is considered sideways action. The market's just drifting higher. And yeah, it does follow this trend. The trend for the last month or so has been up, but it's really flattening out. And like I said, there just haven't been many technical developments lately to mention, worth mentioning. So there's your trading range, and we need to break out of that. Maybe we'll continue to grind higher, but if we look at the 2-hour chart, 120-minute chart, this tells another story. This is a bearish rising wedge, breakdown back test. Here's that big gap that I've putting a lot of stock into, the call it the New Year's gap, from the December 31st closing lows to the first trading day on January 4th, and then that back test of that trading range. So these two horizontal lines right here really help define that gap. And you can see that prices, we actually punched into it a few times. We had an attempt to get into the gap there, couldn't backfill it. Another attempt, couldn't backfill it. Gapped up into it, and we're in the gap, trading in there, but this is lackluster behavior. Typically when a gap is entered from above or below, it is filled in a pretty impulsive manner, and that hasn't been the case so far. The bearish divergences here, seen well on the 120-minute chart, indicate a likely trend change. So that's what's going on here. We'll take a quick look at the SPY, S&P 500 tracking ETF, and same story. If I try to capture the highs back on the 17th, roughly a month ago, there we are today. We're 1.82%, so not even 2% higher on the SPY. So really, nothing to celebrate. If you're a bull, the market hasn't rolled over, and bears, I know, are getting frustrated to no end. And again, don't trade the broad market is my advice, at least not right now. If you're short, there's no problem being short and putting stops not too far above. You can see all these downtrend lines. I've flipped over now to the weekly charts, and we'll wrap up there. I'll keep this video relatively brief. Here's downtrend lines off the highs, the 2015 highs. And so far, as you can see, we're in what simply, is unarguable, a primary downtrend, defined by a series of lower highs, i.e. this downtrend, and lower lows so far. And this is the S&P 500, widely referred to as the broad market. So yes, if we continue much higher, what happens? Well, we take out these previous reaction highs right here on the S&P 500 or the SPY. Then we take out the all-time highs right there. And so each and every one of those events, weekly close above this downtrend line would be another bullish event. So you have 1, possibly 2, 3. And each of those strengthen the bullish case and diminish the bearish case. But right now, you can see the trend indicators that I've talked about that work so well. The PPO, especially the signal line, the 9 EMA, when it's above 0, it defines primary uptrends or bullish trends. When it's below, as it was back throughout the bulk of the bear market in 07 to 09, that line was below. We had a period there with a correction that was actually a bear market in some of the major indices, like the IWM and some others, or it dropped more than 20%. But either way, a very healthy correction. I don't want to call it a bear market because some of the major indices just missed that 20% drop. But you can see now the PPO has told us for a while that the trend is bearish, and we had that failed back test from below. That's often seen during bear markets. You see the back test from below. And, that's just one of many things there. And of course, we had the divergent high leading up to the 2015 highs. And so, until proven otherwise, the bigger picture shows us in what's quite likely the early stages of a primary downtrend. And sure, will it, can this be a correction? Well, only time will tell. If we take out all those levels that I talked about, one after another, these downtrend lines in the major indices, the previous reaction highs, and especially the all-time highs, well, then obviously that was my analysis was wrong and this was a correction. And who knows, maybe we punch up, make a marginal new high just to make sure that all the bears are shaken out before headed down. I don't know. But right now, I'm not overly concerned with what the broad markets are doing. More so these individual sectors, because there is a lot of sector rotation, a lot of money to be made, most on the long side lately, and that's reflective of the trade ideas. I put up this longer term bearish analysis, but if you take a look and just see what the trade ideas posted in both the trading room and on the front page have been over the last couple months, the vast majority of the trades have been on the long side. So, the trend is up. And it's getting a little frothy, so I'm personally, I'll book some profits today on some holdings, some longs, and I may begin to start scaling into some more shorts here soon, and I'll tell you why. Let's go ahead and move on forward with this video. So that was a SPY. There's the Q, similar downtrend line. The Qs, had a sort of a mini flashback here, a mini crash, I should say. That's somewhat of an errant candlestick, but the nature of the pattern is the same as a SPY. You have the multi-month, multi-year actually divergent high, primary uptrend line, breakdown, back test, prices rolling over, and the PPO remains in bearish territory. What else do we want to look at? The IWM, small caps, missed that. Let's try it here. There's the small caps. They're well off their highs, not even close to making new highs. This looks like a megaphone pattern, if you will, but I'm watching this downtrend line, so there's something to watch. And if and when they take out that downtrend line, you have that reaction high here around, call it 120 roughly. So that one still has a lot of work to do. And by all accounts, just looking at this chart, this shows us we have been and are in a confirmed downtrend since the middle, June of 2015. So going on almost a year now. That's that. I don't know any other way to spin it. So, if the IWM has a lot of work to do to get up there and take out all these levels. This will be, if we get there, very formidable resistance. You can see that reaction high around that 120 level that I mentioned. It goes back here. We have some reaction highs. Here, zoom in a little bit and you can see it better. Reaction highs, punched above there, held above it for a little while, and that was support when tested from above, then broke down, back tested, and we're moving lower. So again, that helps formulate my longer term thinking. And of course, there's no denying that the trend for the last few months has been bullish, but that is most likely to end soon, in my opinion. Now let's take a look at the Qs. I like to do this a lot. The Qs have always been, for years, the leading index. They led this market up from the 2009 lows, and the Qs are very top-heavy index, the Nasdaq 100, when I say the Qs, with Apple being the largest component. So let's take a look at Apple. Here's a weekly chart. I've mentioned in the past this 40-week EMA, which is the same as a 200-day moving average. Does a great job at defining bull and bear markets. That's on my live charts page. You can see a longer-term chart there of Apple with that 40-week moving average. And I also mentioned a few weeks back, even when we were down below it, that it's not uncommon. In fact, it's more common once a downtrend has begun to see that level taken out. We saw it here. We broke below it, the red line, came above it for a little while, a few months, and fell back below. And, there's a few, like any moving average, it doesn't do a perfect job of defining the trends. But so we're above it by just a bit. Actually, now that I look at it here, we were above it recently, and now we've fallen back below that level. So there's one sign. Here's another sign down here, the PPO in bearish territory. The divergent high tells me that this long-term downtrend, which was finally broken, is the beginning of a new, longer-term primary downtrend in Apple. And again, that's the leading, world's leading stock, largest stock by market capitalization. And I don't see really any bullish divergences here, at least not on the PPO. So one that has probably more downside to come over time. And let's just take a look at the daily chart, only because it's Apple. You know, I mentioned recently we had this level. Apple started rolling over here. We hit this support level. There was a downtrend line. It tried to take out off the highs. This is a busy chart. I don't have that all cleaned up. Let's see if I can show you anything better on the 60-minute. Let's see what I have marked up here. Yeah, there's a downtrend line, so we had sort of a wedge type pattern. Let's get rid of that line. So I haven't adjusted this for the video, but you can see here we do have, more importantly at this point here, you can see a divergent top on Apple on the 60-minute, and I do like to see 60-minute divergent highs for a swing trade entry. And Apple has now broken that horizontal support level. These are old targets there, and could probably adjust this downtrend line, although that's where I had it before. I think this was a little fake out move. So Apple looks to be headed lower in my opinion. And let's take a look at some other ones here in the Qs. Pull up my watch list, and I'm going through the Qs, the holdings of the Qs, of the QQQ, in order of market cap, descending, with Apple being the largest. Next up, we have Google. This is Class A, and you can see this well-defined uptrend line, bull market uptrend line. And again, I'm sticking with weekly charts here. This is a 10-year weekly chart. You can see the divergent high going back from 2014, so nearly a good 2 years plus of the divergent top. And these are the things that signal longer term trend changes. Now Google looks good, hasn't broken down, or Alphabet, and I'm still going to call it Google. I'll probably call it Google for the next 10 years, but it still looks only a matter of time before it breaks down. You have this sub wedge, or this minor wedge, this minor uptrend line. That's what I'd watch for the first breakdown. You can probably see that better on the daily chart here. One thing I put there is also potential for a head and shoulders pattern. Let me try to clean this up. I told you I'd stick with the weekly charts. I just have a hard time doing that because there's always so much to point out in these stocks. So now what you see here is a gap. We had a gap right there. If I put this horizontal level, which was a level in that other chart, we have support here. We have reactions there from below, gapped above that level, back tested it. But now a gap is just where prices moved up. If I put a line chart on here, you're going to see a line come straight through there. Candlesticks will show those gaps. So now what you have, it looks like the formation of a left shoulder right here, this higher point here being a head, and then looks like we could be putting in a right shoulder. And if we see now, of course, you need to see this right shoulder confirmed, ideally on volume. I talk often that head and shoulder patterns are probably one of the most widely recognized patterns out there, and because that, they tend to have a higher failure rate. Now, they have a higher failure rate not because the pattern is bad, but because most traders, slap a head and shoulders or an inverse head and shoulders on just about anything. You want to see some symmetry. It doesn't have to be perfect, but it's good to see the symmetry, and we have the potential here. You also, very importantly, want to confirm it with volume patterns. The volume patterns, what you want to see on the move down from the head. Once the head is formed, that initial move down, you want to see impulsive selling, as you did here, on above average volume, as we have here. So you can see the volume surge on the formation of the head, and now you need to see the same thing on the formation if we get a right shoulder. So if Google or Alphabet moves down from here, you'd want to see a tick up in volume on that move down, and this would be your neckline, and a break below that level would trigger an entry. So as an aggressive or anticipatory trader like I am, you could go ahead and short Google here with a stop not too far above, because if it goes much higher, it'll take out the symmetry of that pattern, and it'll also take out that previous reaction high, which is bullish. So you could have a stop not too far. And I've done this many times in the past where I've recognized what could be a head and shoulders. They don't all play out, but some do. And you get a much better entry, because then you're shorting up here around 790 with a stop not far above. We're talking just mere percentage points. And, that entry gives you, if the right shoulder is formed, there's about 11.5% drop down to the right shoulder. And then that pattern would probably play out, and this would just rough estimating a target here. I'd have to measure it out, but it's probably another, down to that point would be about a 25.5% drop, and that's probably where that stock would go if that pattern played out. So just one thing. All right, let's get back to some of the other ones in here. Microsoft, a lot of these, the Qs have held up. Nasdaq 100 has been the only index on all my longer term trend indicators that has yet to flip to long-term sell signals. Not far from it. So here's Microsoft. There's a key long-term uptrend line. And Microsoft is still comfortably above it. But again, if you really zoom in, you'll see this better on the daily chart. See these sub-uptrend lines? When I say sub-uptrend line, this is your primary uptrend line. This would be a minor uptrend line. And you can see how it's cutting in the recent price action. So we really have this wedge forming here. And this would spark most likely a correction, and if and when this trend line's broken, bring us down. There's a support level, and then ultimately, if we take out that downtrend line, and we do have the divergences in place to confirm recent overbought readings, and that one has room to fall, and ultimately over time. Well, let's just say right now my near-term target, should Microsoft and the markets roll over soon, would be 40. And you're talking one of the world's largest companies trading at 56.50 right now. And that alone would be a drop of about 28%. So you'd expect the broad markets to fall in line roughly with that if that plays out. I already covered Google and Class A. That's just the other share class. You can see that wedge there. Same, obviously the chart pattern's almost identical. Facebook, well, this is a potential downtrend line that'll come into play. And my guess is if the bearish scenario plays out and the markets are due for another pounding here in 2016, another leg down like I think they are, this would be a target, really an ideal target for Facebook. So we need to see this parallel uptrend line, which is the current more relevant uptrend line, broken, and then that would look something like this. Take us down, and you can see here we have really nice, these are both horizontal support levels, which I deem significant, where I expect a reaction, especially on this one here, especially at 72, adjusting that, 72.90. And you notice how that would come in roughly with this trend line. It depends on if and when Facebook breaks down and how fast it falls, but those could come in together. But I think we'd see something more like this. Stocks tend to fall a lot faster than they rise, so if it broke down soon, I think we'd hit that level first and have a bounce up from there, and then at some point maybe bounce all the way back to this level. And again, this is just one of many scenarios. I'll have to see how the broad market's doing. So a move down could look something like that. All right, let's move on to the next one. And I won't cover all 100 stocks. I'll just go over the top 10 or so. Here's Amazon. I like Amazon. I mean, I'm not long Amazon. I'm I spend a lot of money at Amazon. I'm a Prime member, and I think everybody does. Just about everybody now uses Amazon. It's a great business model. And, the chart, I can't make a very strong bearish case looking at the weekly chart here. I will say that, if the broad markets do correct, they'll probably take it down with it. But this wouldn't be one that I'd short individually. I think there's better fish to fry out there if you are bearish looking for a move down. And again, I'm just right now touching on the top components of the Nasdaq 100 because it is such a top-heavy weighted index that if we just look at the top 5 or the top 10 components, that covers, I think the top 10 are over half the entire makeup or weighting of the Nasdaq 100. Intel, this is a little busy, this chart. Here's a head and shoulders. We actually shorted that back in 2014 or 15, the head and shoulders pattern, and that was a successful short trade. That already played out, so you don't can ignore those lines there. But you can see, the bigger picture. Let me change boards here and get a clean shot of this. This is the bigger picture. The trend is down. Here's a stock making a series of, we had this meltdown here. I'll draw through there. We can draw that if we want to, but so far, this is a downtrend, series of lower highs and lower lows, and it has some work to be done. So just because the market's been resilient over the last few months, that's typical. If it is a bear market, that's just typical bear market action. We had a big correction from the drop, I should say, from the 2015 highs. We had another big drop, and I don't know. That's the way I see it. I see the primary trend still down for this at this point in time. Here's Comcast, CMCSA, Class A. Nice downtrend line here that needs to be taken out. And if you look at this chart, it's just a nice, clean, giant rising wedge. And as I often say, whether you're looking at a weekly time frame, a monthly, a daily, or even a 5-minute chart, an intraday chart, these patterns work the same. These trend lines should be respected. They tend to play out to roughly the same measurements. If you want to figure out how far a wedge is going to go, take the distance of the the widest part of the wedge, add it to the breakdown, and that gives you an estimate of how far that stock might fall. That wedge is confirmed with divergences. If it wasn't confirmed with bearish divergences, I probably wouldn't give it too much attention. But this looks like a wedge that, could, if it wants to, could certainly go on for months. This stock could even go on to make new highs. And as long as it keeps these divergences intact, that keeps that bearish scenario alive. So that one, like I said, has work to do on the downside, and here's a big support shelf right here. So this would be your key level. Fast forward a few months, and if Comcast gets down to the 49 level, and that level goes, then you're in a much deeper bear market that's likely to go a lot longer, because that one, if that level went, and I don't want to get ahead of myself, but that's where the next target would be, all the way down to the 30 level, which would cut that stock in half from where it's at right now. All right, let's see. CSCO. I don't see a lot on this chart that it doesn't speak a lot to me. It doesn't tell me a lot. I do see, the prices so far making lower highs here, moving lower, pushing up against those highs. So that's a downtrend to watch, and it would be bullish, obviously, if it took that out. If it did take it out, remember, just like everything else, each successive reaction high is resistance. So it has its work to do, or I should say its work cut out for it. Here you go. So resistance 1, this downtrend line. Then you have each of these reaction highs. And so far it's heading lower. And just from the look of this chart and look at everything I'm looking at, say it probably comes back down before it breaks out. There's a nice support level there, and that would be a drop of about 6.5% on Cisco. Gilead, here's GILD, a lot of interest in the biotechs, I'm aware, and from the look of the charts, I'm been pretty persistent that this is probably a bear market rally with a lot more to go. These stocks got insanely ahead of themselves on this tremendous rip from 2011 up to the 2015 highs, and just from the looks of the charts, the steepness of these trend lines with the steep, powerful divergences in place, the price action so far, breakdown backtest, it looks like these things have more to go. And I'm speaking generally about the group. Here's AMZN, another biotech, primary uptrend line break near backtest, and steep divergent high. Maybe that was it. Maybe that's all they needed to do before they shoot off to new highs. But I still think the risk to reward, if you're taking a longer term approach, is more skewed, more favorable to the downside. And to translate that in other terms, just means the next 20 to 30% move in this stock is probably to the downside before the upside. This would be a longer term target. This would be the next target zone right here. We'll do 2 more and then we'll wrap it up. Here's Starbucks, and again, the market hasn't cratered because a lot of these, key stocks have still held up, and that's what's really held this market up, some of the leaders. So here's Starbucks, multi-year divergence with this price channel here. This I call it a contracting or ascending price channel. It's slightly contracting, ascending, meaning it's moving up. And this would be a target down here, ultimately call it the $40 level. But to get there, Starbucks will first have to take out this downtrend line. So and I do see that as the most likely scenario for this stock. So it has some room to go. It has to drop about 16% or so to get there, and then from there, at that point, I would expect a reaction first, but then ultimately continue on down, and that's about a 35% drop in Starbucks. And we'll wrap it up with WBA. Walgreens Boot Alliance. Walgreens, big drugstore chain. Nice uptrend line here, the white uptrend line, breakdown. And so since this breakdown in initial thrust up following that primary downtrend line break, you have these yellow downtrend lines which form a descending price channel. So, I don't know how much longer it's going to walk down nice and tight within this channel, but that just shows you the trend from this point. The primary trend is down. Nothing here indicates otherwise, that that trend is in jeopardy. You know, the PPO's in bearish, has a bearish posture right now. In addition to both lines being below the zero level, looks like an impending, you know, we see the PPO line curling down for maybe an impending bearish crossover. So that's that. And again, if anything changes, like I said, I don't want to read too much into the charts because it's just been a slow grind higher. Here's WBA just going back for the last couple months. And, you know, here we were back in the beginning of March and prices are below there. I probably should have done that with a lot of these leaders. So, you know, a minute ago I went over the Qs and the SPY on the 60-minute charts. Now you look at the leaders, it looks like these leaders are finally rolling over. Google's a little bit higher, so is Microsoft, but I went through Apple, there's Facebook. You can see a lot of these stocks have gone absolutely nowhere or in fact are lower in the last month or so. So it appears to me like this market is just, it's tired, that's all. And until we get start to see it either roll over and pick up some momentum to the downside, or go ahead and move on up and break out, take out that gap on the QQQs, take out those downtrend lines off the 2015 highs, especially on a weekly closing basis, not so much on a daily basis, and all those previous reaction highs. It's probably going to be tough sledding here, trying to trade or figure out what the broad market's doing, and that's why my focus continues, you know, right now remains on the, you know, just trading the best looking setups, long or short on individual stocks. But you know, if the markets start to melt down, I have no problem jumping back into the index shorts. You know, short those 3-time long ETFs is what I like to do to take advantage of the decay. So there's a little megaphone pattern on Facebook after, you know, this trend line breakdown, high level back test, and Facebook's been rolling over since. So that's just one of many. Okay, guys, I'll stop it here. This has been Randy Finney with Right Side of the Chart, and I hope you enjoyed it.